Are you thinking about tapping into your home equity and you're not sure which route to go, whether you're thinking about a HE loan, which is a home equity loan, or a cash out refinance? You've come to the right place, and that's what this video will be about. If you haven't seen my channel before, my name is Seanu Uyehara. I'm a branch manager with Loan Depot, helping you finance your homes all across the country. Whether you're a first-time home buyer or a seasoned investor, we've got you covered coast to coast. And if you have any questions, you can always send me an email. In the description, you can also find more information on how to get your mortgage right. Whether you need a free analysis on your mortgage to see if you can save more money, or you want to refinance, or you need a second opinion on your home purchase, my team has got you covered. Now, because where the economy has been going over the last 6 months, it's put a lot of fear in a lot of Americans. Inflation's up. You're probably not working as many overtime hours. Maybe your employer is not paying you as much as they were before. And you have a house that you've got some equity in. What do you do with that equity? Well, the first thing you have to do is be very, very smart about what you do with the equity. And I know that might sound very obvious, but I've had conversations with a number of you that watch my channel that have talked about doing renovations in your home. And I do not think that is the smartest thing to do with your money right now, simply because you are taking money out of your house and taking on debt just to make your kitchen look nicer, or your bathroom, or your living room, or whatever you decide to renovate. Now, unless you have to renovate your house for whatever reason, maybe you're selling it, or maybe you're flipping a property, maybe you need to do that. But for aesthetic purposes, I don't think that's the best use of money. Unless you have a nest egg and you make a lot of money and it's not really going to hurt you, then maybe you want to look at that. But for the most part, I would say right now, you have to hunker down. You have to eliminate unnecessary debt. So when you look at the two options in the video, like we said, we're going to talk about a HE loan and a cash out refi. The reason you may want to take out a HE loan is simply because you can probably get through the process a little faster than a refinance. I've never personally done one. Typically, when you do these types of loans, you may be going to a larger banking institution or maybe even a credit union. I know that my credit union offers one, but I've never opted to take a HE loan. I've always done helocs in the past, which is a home equity line of credit, because I like the ability to draw on the line and use it for as many times as I want. If you get the HE loan, let's say you needed $50,000, you would get the $50,000 at closing. And then I just looked up a couple of banks online, which you can see right here. I'm not going to name the name, but they have an 8-year term at 8%, or you have a 15-year term at 7.95%. And you can see with the fine print that those rates are shown for loans in the amount of $50,000 to $99,000 up to a 70% LTV or loan to value. You also have to have a FICO score of 730 or higher. So even though these HE loans or helocs, because they're pretty synonymous and a lot of people kind of throw them around quite frequently together, you're limited on the funds that you can take out of your house, and your qualifications are a lot more stringent. So a HE loan may work better for you. However, you have a shorter period of time to pay the money back, which means your payment's going to be significantly higher than if you were to do a refinance and spread it out over 30 years. And also, on a cash out refinance, you can refinance up to the loan to value that Fannie Mae or Freddie Mac or even FHA allows for, which is going to be higher than 70% unless it's an investment property. So you can take out a little more cash on a cash out refinance. There is no cap as to the dollar amount that you can receive. You have to just meet the loan to value guidelines, which is basically what you owe on your property divided by the property value. So if you owed $80,000 on your house and your house is worth $100,000, that would be an 80% loan to value. And from this specific bank that I looked at, their loan to value was 70%. So in our case, you could get another maybe 10% more through the cash out refinance. Again, in this specific bank, they're looking at a 10-year or 15-year term. On a traditional cash out refinance, you can go up to 30 years. You've had some banks talk about 40-year mortgages. You could also look at a 20, 25 years. You have more options, more flexibility to spread the payment out further. Of course, there's no prepayment penalties. So if you are coming into a larger amount of money in the future, you want to pay your mortgage down, you can do that. And don't forget, I gave out a hack before on my channel talking about recasting your mortgage. So if you do have a large sum of money that's coming in, one of the biggest hacks that people don't know about is that you can call your mortgage servicer up, so the company that you're making your payments to, and tell them you want to do a recast. And basically what they'll do is they will tell you how much money, one, you have to put down. And then also they will re-amortize the loan based off the new balance without resetting your mortgage back to 30 years. So it's a really cool way to be able to pay your house off faster if you're in a profession that you receive commissions, or maybe you own a business that you're selling it, or maybe you sold an investment property or something else and you just got a large sum of money coming your way. So I would say if I had to choose between the two, the HELoan would probably be better if I need a smaller amount of money. I would say something that's probably going to run you less than $50,000, because if I'm paying it back, again, based on this bank scenario, in 10 years or 15 years, I would want a more manageable payment. And this is why, like I said, if you are taking out money out of your house just to fix it up, you're going to be paying another $500, $600, $700 a month just to have a nicer kitchen. Can you afford that right now? And do you want to take on the extra stress? Again, it's your decision and you have to figure that out. But I would say in the market that we're in right now and the economy that we're in, probably not the smartest thing to do, but to each their own. And I'm not here to judge anyone, but just my point of view, I wouldn't want to take on the extra debt simply because we're trying to make the house look nicer. Now, if I needed a larger amount of money, talking 50+ thousand or more, I would probably look at a cash out refinance, simply because I know the payments are going to be lower and I can manage the debt a lot easier doing it that way versus taking on the higher amount. Now, if I were to take out any sort of equity out of my properties today, I would be looking for an investment that's going to produce cash flow. That is the biggest thing, because if I can find a business, if I can find an investment opportunity, a rental property, it has to spit out cash flow every month, because that has to help me service the debt. If it can service the entire amount of debt, that's fantastic, because now I'm controlling another asset without necessarily having to spend money out of pocket every month to maintain it. And obviously I can build up my reserves over time. But in the ideal situation, I want to be cash flowing at least a few $100s a month, because now, even though it's not life-changing money that I'm going to wake up and look at my bank account and see another $1,000, $2,000 deposit, you're probably not going to find that today. However, if I can control something where it doesn't cost me money, why would I not look at that opportunity? And also too, remember, things are getting tough for a lot of people. So you might be able to find a deal on a business or something that maybe that seller wants out. Maybe they're stressed out of the business and they just want to leave. I was having a great conversation with a friend of mine the other day, and he was saying that he had a client who owned a trucking business that wanted to get out of the business. So he wanted to sell, but he said, look, what if we can do certain things to the business to streamline it a little more for you? Would you mind keeping the business around? And they ended up actually keeping it longer than what they thought. But my point in sharing that with you is, you don't know who's out there who's maybe getting to wit's end about their business, their rental property, or anything else that they may want to sell. So if you have some cash from your house, other investments that you might have, you might be able to move the money around to take advantage of that. But I'm not going to take the money out to go on a vacation, put money into a college fund, put money into my house, unless I'm going to sell it or I'm going to flip it. I want to make sure I'm buying something that is spitting out money to me every single month. I think if you can do that, both routes are totally fine. However, in my opinion, the smaller amount of money, I'd probably look at a HELoan so I can get rid of the debt, pay it off as fast as I can. If you need more, you're looking to get into a bigger deal, look at a cash out refinance, lower payments, interest rate's going to be a little comparable, but I have more flexibility with that. I'm not going to stress myself out over a higher payment through the HELoan. So cash out refi, if you need more money, HELoan, smaller amount of money, you know you can pay it off faster, go that route. Be smart with your money. Be smart with the opportunities that are out there. Winners are always looking for opportunities, and I wish you the best. If you have any questions, need a second opinion, send me an email. My team and I are here for you. I'll see you in the next video.